Hey everyone, welcome to Retire with Style. I'm Wade, and I'm here with my trusty co host Alex. And we are at the final episode in the arc on long term care insurance today. We'll be talking specifically about the different features of long term care insurance. And I may have said long term care insurance is the arc, but that's only been one part of the broader arc on long term care planning. So I may have misspoken a bit there. But
No
how are you,
worries,
Alex?
Wade. I'm doing good. You know what I've realized while you're doing that intro? It's very possible that when we started this arc, some of our listeners did not need long-term care, but
No,
now by the end of it, they're in that zone. What do
years
you
later,
think?
they've progressed to the point where
Yes, years
that's
later.
consideration.
No,
That's
but
been a lengthy arc.
yeah. Well, I mean, look, it's part of our style in terms of how long is the arc? As long as they need to be for us to cover the important information. I mean, that really is what it is. We're not, I think people get the joke already from our podcast. We're not going to deal with topics lightly. I don't take myself too seriously, but when it comes to the topics, we drill down. I mean, we had the annuities, the investment arc, Social Security arc, et cetera, et cetera. So they're as long as they need to be because we realize that a lot of this is evergreen and you could always go back to it. And we want to make sure that we provide the depth that the topic matter necessitates. And with that, no one's happier than me that this is the last episode of this arc, but that's fine. What are we going to talk about today, Wait, to tie a bow on this thing?
Yeah, so it is where the last episode we went into detail about long term care insurance, but we didn't really talk about how the benefits work in terms of how long until the benefits start, how long do they last, is it paid per day or per month, is it paid in cash or do you have to submit receipts, all kinds of issues related to inflation adjustments is another thing. So we just want to break down all the different features you need to be thinking about if you are going in the direction of long-term care insurance. And this discussion applies to both traditional long-term care insurance and then the
Yeah.
hybrid life insurance
So is it
long-term
fair
care.
to say that there's four basic things to cover and beyond, which is, and you can listen to us, and it's very natural to have these questions asked, which is, how much time passes before the benefits start? How much in benefits are provided per period? How long are the benefits provided? Any other question I'm missing here, Wade?
What is the total benefit pool available?
Ah, yes, it was on the tip of my tongue. It was on the tip of my
There you
tongue.
go. That was
Thank you. Thank you
very
for
good. How do you get
batting
one of those?
cleanup. Thank you for batting cleanup, Wade. All right. And so with that, why don't we talk a little bit about, the benefit periods and all of that with talking about elimination or waiting period.
hmm and so that's just the issue of how long do you have to wait once it's been determined that you have a long-term care need, which we've discussed before. Generally, you need help with at least two of the six broad activities of daily living. So it's been certified, you have this need. How long do you have to wait before benefits kick in to start making payments or providing those benefits? And that's the elimination or waiting period. And it can vary. Uh, it could be a month, it could be 2 months, it could be 3 months, 90 days, it could be a year. This is where you have some flexibility, and naturally, the longer the waiting period, the less expensive the insurance. So, long term care insurance can be costly if you're trying to find compromise. Having a longer waiting period could be an option if you feel like you could self fund the first 90 days of care and have the long term care kick in at that point. That would be a cheaper policy, and it could be significantly cheaper than if you only had a 30-day waiting period. At the extreme, if you could have a 1 year waiting period, well, that would dramatically lower the cost of insurance, though you would need quite a nest egg prepared to cover the 1 year of care. But that's the idea here. That's the trade-offs. You can think of the waiting period as a kind of deductible. And so the longer the waiting period, the higher the deductible. And so the lower the cost for the insurance.
Okay. And so with regards to the elimination period, which, I've been accused of being sophomoric in my humor, which I'm holding back a great
Someone
deal,
accused you of
Wade.
that?
Huh?
Someone accuse you of being sophomoric in your career?
Yes, not in those words, but you know. Uh, with regards to determining the date and things like that, can you maybe want to describe the difference between calendar days and service days and what
Right,
that
right.
means
Yeah,
in the grand scheme of things?
it's another important distinction. So suppose you choose a policy with a 90-day waiting period. Well, how's a day defined is the next issue. So if you choose calendar days, it's pretty much just counting, okay, it's been determined you have a need 90 days later, your benefits will begin. That would be the calendar day version. The alternative is a service day provision, which is it's been determined you have the need. Now, if you're only getting care 3 days a week, we're counting that as 3 service days for the week. So only 3 of the 7 days in that week would count. And so to build up 90 days as a waiting period, that would be 90 days where care is received. So, of course, if you're not receiving care on a daily basis, it's going to take longer to qualify with a service day provision than it is with a calendar day provision.
Hmm.
Naturally, that should make the service day version of the insurance cheaper than the calendar day version. But that's the distinction. Am I counting up 90 days? That's the calendar days. Or am I actually having to count out these are the 90 days where I received care? It could take 180 days, 200 days to do that. But is that how it's defined in the contract?
And a question that somebody could be asking is, so which one do I get, or which one do you suggest? It's kind of an unknowable, really. But what are some trade-offs to be thinking about?
Well, calendar day would certainly be a lot easier on whoever's been tasked with having to keep track of this because you have to provide receipts and evidence and proof about service days. So, all else being the same, I would lean towards the calendar days. And then the trade off would be just having a longer waiting period before the benefits begin versus, say, having a 60 service day waiting period, 90-day calendar day waiting period, whatever the case may be. I think it's easier to manage the calendar days and the service days, but just know this distinction is there and be careful about which one you're choosing.
Okay, and then when you're talking about days and the like for accessing, is something that I started thinking about that we have on our list to discuss is the benefit amounts. When there's a monthly amount or daily amount, which there's a maximum daily amount or a maximum monthly amount. Maybe you want to talk
Mhm.
about that a little bit so folks can realize, oh yes, we could get more complicated.
Yeah, there's a couple of different details here, but most policies will either pay, they'll have like a pool of benefits per day or per month. And we'll talk about this can make a difference. We'll give an example a little bit later on. But then the period of coverage, how long do those benefits last? And then what's the total benefit pool? In most policies, if you're using less than the allowed coverage per day, and that would be more with a reimbursement policy where you may have $300 of coverage for the day, but you only spent $200. You turn in the receipts, you reimburse $200. Your total benefit pool would extend the length of coverage until you had access to all the available benefits. So the total benefit pool becomes important. If you have, for example, a daily policy, $150 a day, 5 years of coverage, then the total benefit pool you'd calculate out. You have 150 times 365 times 5. Do that in my head. That's $273,750. That would be your total benefit pool. And so you'd be able to spend up to that amount, but tracked out on a daily basis. Suppose instead you had a policy that covered $4,500 a month for 3 years. Well, your total benefit pool would be 4,500 times 36. Alex?
162,000.
Oh, good.
162,000.
Good. Yeah, you're you got that one good. So
I'm an
162,000.
excellent driver. I'm an excellent driver. I'm an excellent driver.
Yeah, but then you'd have a total benefit pool of 162,000. And then again, if this would be more relevant for a reimbursement policy, and we'll talk about that specifically later on. That's where if I had $4,500 a month, but I'm only spending $4,000 a month, I could extend that out if it was 36 months of coverage. Well, I'd get to keep going for additional months until I hit that total benefit pool limit. That would have been calculated based on using the full coverage per period for the number of periods that the
So
policy
so the
covers.
quick and dirty is, if you go over your daily amount, you're going to get cut off. But if you go under your daily amount, it'll just they'll keep track of that piggy bank, if you will, and you'll be able to use the full amount of the coverage eventually,
Right, and
ultimately.
that's true with the monthly version too. Yes,
Yeah,
if you
yeah,
spend more
that's
than the limit, you have to cover the excess out of pocket. If you spend under the limit, it will extend the terms of the policy until you've been able
so
to
it's not
cap
a
under your
use it or lose it kind of thing.
right. Right. In that regard, it's not. Yeah, it's not on a daily basis. Use it or lose it.
Okay, no, no, that's good. All right, and then when it comes to these expenses and the like, do you want to talk about inflation?
hmm So inflation is important. It's important because, well, we know normal consumer price inflation can be relatively higher than we're used to in the past. So, but even
Yeah, but
if,
when you're thinking about like this isn't, long-term care, let's say you do it at my age, 20, 30 years before you use it, it's hard to conceptualize the numbers, right?
yeah,
And so
yeah,
this
and
becomes
so
front and center. And you said in the last podcast, you kind of assume a 50% inflate, not a 50% inflate, a premium. You just naturally bake in your premiums will go up by 50% just to be on the conservative side.
on the traditional policies,
Yes, on the
yeah.
traditional.
hmm Yeah, that would just be for the premium. So we're talking now about the benefits.
Oh, that's right,
Are
that's
the
right. My bad, my bad.
yeah, are the benefits inflation adjusted? Consumer price inflation, if it averages 2 or 3%, usually long-term care inflation is higher than the overall consumer price inflation. So if you're thinking 2 or 3% might be okay for overall consumer prices, you might be looking at 5 or 6% as the potential inflation rate on long-term care. And right, if you don't need that care for 30 years, 5 or 6% inflation can have a huge impact. That if you don't have any inflation adjustments in the policy, $150 a day per day today may not amount to a whole lot 30 years from now. And so you may want to look at building in inflation protection into the policy. Now, that's going to be an expensive benefit to have those benefits tracked to some sort of inflation rate. But you might look at, say, a 3 to 5% inflation rate. And then you also have to keep track of, is it a simple rate or a compounded rate? The simple rate is just based on the initial benefit. It increases 3% of that initial value each year on an ongoing basis. Compounded gives you the growth on growth. So a year later, it grows by 3%. The year after
Yeah.
that, the previous year's benefit grows by 3%. So you're getting that growth on growth. So you're going to get more of that exponential curve rather than a straight line with the growth on the benefit. And over a long enough holding period, the compounded rates can catch up so that it does take more than 30 years, but a 3% compounded inflation rate will eventually give you a bigger benefit than a 5% simple inflation rate. So you've got those options. Of course, the higher the inflation rate, the more expensive the insurance. And compounded is going to be a lot more expensive than simple for the given a given inflation rate. But
Yeah,
this
but
is
I
a way
mean,
to help protect the value of those benefits if you're not using this insurance until the distant future.
and I'm just thinking there is no gotcha. Like there's no pricing inaccuracy. The insurance companies aren't going, I mean, you just have to think, right? The insurance companies aren't going to sort of embed something with a huge inflation rate and charge the same. You're paying for the benefit, so it's just your mental trade-off on how you want to play this, if you will.
Yeah, it's doing those actuarial calculations on when is an individual most likely to need the long-term care, how far into the future is that, and so how much inflation growth would there be on those benefits, and accounting that into the pricing of what do the premiums need to be to afford those inflation adjustments.
Got you. And so, while you were speaking about how things were priced, it made me think when we were discussing the annuities, how, annuities are priced fairly, and these are the components of how you price annuities. You got to take the mortality, the this, the that, etc. How is that done with long-term care? Because you started talking about, if you choose inflation, you're going to have this kind of, it's going to be a higher price, etc., etc. What are some methods that sort of you can point to that will indicate how they're determined and paid?
You're asking how the actuaries price out their long-term care insurance?
No, no, more like how
It's
benefit
hard.
amounts are determined and paid, like in a general manner.
Oh, just like how do the inflation adjustments
Yeah.
work? Yeah, and that's relevant to our last point too. So every year, if you have a daily or monthly amount, that would increase by the inflation rate embedded into the policy, and then your remaining benefit pool would be increased. So that this was that issue of if you weren't using the full allowed amount, you're going to extend the length of those benefits. So remaining benefit pool and then the daily or monthly amounts are going to be adjusted each year to reflect the inflation rate embedded in the policy. And I don't think there's really any policies that would link to an actual like inflation rate in the manner like a TIPS yield works. It really is going to be a fixed cost of living adjustment or fixed benefit adjustment. Again, commonly either 3% or 5%, simple or compounded. Although a 5% compounded would be an incredibly expensive provision to include in the insurance.
Gotcha.
Yeah. And so another kind of angle of, and we were touching upon this a little bit, but how are the benefits paid? So, and Rob Cordeaux was talking about this. He was talking about the reimbursement method. There's three general options. There's the reimbursement method, the indemnity method, and the cash method. The reimbursement method, everything else being the same, would be the cheapest because it requires submitting receipts and being reimbursed for the benefits used. Now, at some level, that's what you want because you don't really want to pay for insurance that would pay you more than you actually spend to give you some sort of windfall. I mean,
Trust me,
it's
you paid at the
expensive to buy
beginning.
the. Sorry.
You paid up front for that.
Yeah, you've already paid up front. So at some level, the reimbursement method may be the cleanest. However, it requires a lot more effort because, and usually when we talked about this in a past episode, when we say you as the one receiving long-term care may not be the one collecting your receipts and submitting them to the insurance company, but somebody needs to be collecting those receipts and submitting to them to the insurance company and getting reimbursed up to the daily or monthly limits for the expenses. Now, the indemnity method would pay you that fixed amount, whether it's on a daily basis or a monthly basis, if you received care. Probably these are going to be more common with daily methods because it's okay if you just demonstrate I received paid care on a particular date and I have $150 per day, say, as the benefit. Well, I submit that I received that care, I'll get the $150. It doesn't matter if I only spent $10 on the care, but I'd get that daily payment any day I received care. And then the cash method is more generous, the most generous in the sense of paying the most benefits, though again, it's going to be more expensive. It's not a free lunch by any means. But
No.
the cash method is just going to pay you that daily or monthly amount once it's been determined that you qualify for benefits. Now, the value of that potentially is if you do have an unpaid caregiver, family or friends, you would not have any receipts to submit. And so an unpaid caregiver is not going to get reimbursed under the reimbursement method. But if you had the cash method, you'd be able to pay your family member or friend who's otherwise not employed or not working in this regard. They're just helping you out. You could actually pay them something for their efforts or for the time they're away from work and so forth if you have a policy that pays with the cash method.
But
So its benefit is being able to pay volunteers or unpaid caregivers. I guess then they are being paid, but it's more informal there. There's no, I don't know if you have to submit a 1099 or not, but something along those lines. Versus the reimbursement method, more effort will lead to cheaper insurance, actually reimburses for paid expenses.
yeah, to me that's more of a one-on-one. It's kind of like the pay-as-you-go seems just cleaner, to be honest. A lot of less uncontrollables. But is there a dynamic between the benefit period when it's daily or monthly that if the daily amounts are different, that may benefit one better than the other?
Yeah, and let's create a little example here because it will show how really a monthly benefit can be more flexible than a daily benefit. So suppose we're just comparing two policies. One, it's going to pay $150 a day on days that you receive care. So it is more of this like indemnity method. $150 a day for days you received care versus $4,500 a month if you received care in that month. Uh, I'm sorry, it's not that it's indemnity. I need to start this example over. It's a reimbursement method, so you have to submit receipts, either $150 a day or $4,500 a month. So if it's a 30-day month and you received care every day, they'd be the same. But suppose the scenario is this is reimbursement. You have to submit receipts. 20 days in the month, you spend $200 for care per day. So you're spending a total of $4,000 in that month. If you had the daily method, you can only submit up to $150 of expenses per day. So for those 20 days that you received care, you can get reimbursed $150. You'll not get reimbursed for the full $200 of expenses from that day. So you, for that month, you would receive $150 per day times 20 days. $3,000 would be reimbursed. Whereas with the monthly policy, you can be reimbursed for up to $4,500 for the month. So you submit your receipts, $200 a day for 20 days in that month. That would be $4,000. So the monthly policy would reimburse you $4,000. The daily policy would reimburse you $3,000.
So
And
it
that's
would,
where there's just flexibility with the
yeah,
monthly policy.
it makes sense for me if you have, again, making this up, but if you had like every 3 weeks, you had like a big ticket item as part of your health care that is, I don't know, whatever, exceeds the daily limit,
Mm-hmm.
then the monthly would be the way to go. That way you're always kind of, sneaking in under that.
Smoothing it out.
Yeah. The other piece, and I don't know if you know the answer to this, Wade, but the administrative part of this sounds quite onerous, especially in consideration that this is long-term care and the person activating it is probably not in the best mind and body kind of capacity to be able to all of a sudden become a personal controller for themselves.
Right. Right.
And so obviously you can have a loved one that can do it. I'll be calling you to handle my
The
receipts, but
receipts.
yes, yes. But what what devices do folks like that have available to help them with this if
Well,
it does become
outside
an
of
issue?
the family or friends, kind of
Yeah.
your who's got the power of attorney,
I'm also
that'd be
thinking
the
caretaker because you had said, there's someone that helps organize,
oh
that
the
kind of.
yeah, there's the care coordinator, but I don't think
I don't think
they
so
would
either.
do
Huh?
this.
Yeah,
Uh,
I'm just thinking
there
out loud,
are
like, man, there's a lot. If I had to do daily receipts, I mean, I might as well just.
well, there are professional money managers, so that but this would be where the person with power of attorney, who's like the adult child who's helping out with this, if it's too much for them to handle on their own, they could outsource to a money manager, personal money manager type person.
I guess you're right, but that's a little different when the money manager starts having check writing privileges. It's very specific, with regards to now being a custodian, perhaps from an SEC standpoint. So that could be tricky, but it's just a passing thought. Just listening to you, thinking, wow, it just really hit me. Not that I didn't know before, but all of a sudden, that is a lot of admin to have
It
to
is. Uh-huh.
to have to.
Yeah, it's a lot of work to
My
submit all the
goodness.
receipts and get reimbursed.
Yeah,
And it's in many cases not going to be the patient, right? Care recipient who is
exactly.
doing this.
So before you need it, be a nice person. So qualifying expenses. What are some of these expenses?
Yeah, so this is, and we actually talked about this point some with the last episode. It's just what's covered under the policy. Does it cover in-home care, assisted living, nursing home care, respite care? Will it pay for the adult daycare center, like we talked about with Jackie Smirka on a great episode
Yeah,
from
yeah.
the series? Just what will the insurance cover, and make sure you fully understand those terms. And there's always the issue that new things can be invented, new care options can be invented. What will it cover in that regard? Will it cover for dementia, that sort of thing, in addition to the activities of daily living? Uh, those are just some of the considerations to keep in mind about what's a qualifying expense that can be reimbursed or
Okay,
that otherwise would qualify as a service day or to get the indemnity payment.
well, what I would say too is, there's a standard 2 out of the 6 standard activities, etc. But there is no unif. I mean, there are standards, but are there differences between policies about when they qualify or not, and what should you do
Yeah,
about it?
this you got to be careful with the contracts because there is the general 6 activities of daily living, but they can be defined differently in different policies. And so you need to check that. And one example would be bathing, which is often an activity of daily living that is one of the first that someone needs help with. But how is it defined in the particular contract? Does it you if you can't get into climb over the bathtub, does that qualify? Or if you're able to give yourself a sponge bath, would that mean you don't yet qualify? You just want to make sure you understand exactly how those activities of daily living are defined because this is something that unfortunately is not standardized across policies
Don't
and
worry, wait,
you got to read the
wait,
fine print.
wait. I'm gonna pay it forward with you. I'm gonna put you on the driveway of my house. I'm gonna put a sprinkler. That's just covering a very tight zone. I'm gonna turn on the water, and you're all set, buddy.
There you go. Well, you've
All
got that
right.
outdoor tub for your cold plunges that
Oh
may
yeah,
fit
yeah,
the
yeah.
purpose. For...
But yeah, but this is yeah, right. But no, it's a good point. Like, what is considered bathing? That simple trigger could have significant ramifications. So yeah, read the fine print there.
Yeah, and also is cognitive impairment covered even if the cognitive impairment does not prevent someone from doing their 6 activities of daily living?
Okay. And again, standard definitions do not exist, so just make sure that you're able to operationalize each of those definitions with each policy. All right. Now for couples, we didn't explicitly talk about couples and if they can pool their benefits. Let's say the couples have a predefined pooled benefit. What's the what's the underlying themes or things to look out for there when it comes to this?
Yeah, so with the traditional policies, I think pooled benefits are less common. It's each person has their own individual long-term care policy. Maybe there's a discount on the premiums if both people get it. But in the hybrid world, there could be the option where you have a pooled benefit. So instead of having each person with a separate 3-year policy, you could have one joint 6-year policy that they can both tap into. And that can be cheaper than having, say, 2 separate 3-year policies. The only potential risk there is if one of the spouses ends up using all 6 years, there
It's
wouldn't be
fine.
anything left for the other spouse.
Now, you use the word hybrid. Do you mean hybrid in the way that we were using it in the previous episodes, a hybrid
Yes.
policy?
Yeah, hybrid with life insurance and or annuities, but more commonly life insurance.
Okay. And so then if you're a spouse and you get 6 years, it's if that person uses the 5 years, you may have one left, kind of thing, to go back to it. There may be 1 year left for the other spouse to use, or if that person, I don't know, 2 years later gets sick again, he can use up that extra year, he or she. Is that correct?
Yeah, it's just there's a total benefit pool that they can use on a first come first serve basis till it's gone effectively.
All right.
And that can be cheaper again than having individual policies.
And I remembered you mentioned with hybrids, the underwriting. The underwriting could be a little, I don't know if easier is the right word, but less demanding. Do
Mm-hmm.
you want to maybe
Could just be a
unpack that?
questionnaire and basic blood tests, that sort of thing. Traditional long-term care insurance can have a much more extensive underwriting process. Now, this is where it's important to shop around some because depending on the different companies may give you a different health classification, which could impact the premium costs. You may not qualify with a particular company, whereas you would with a different company. And Rob Cordeau pointed out in our episode where we talked with him, this is where a professional, long-term care professional may be able to help coordinate that process because it's not necessarily good to get a rejection that may make it harder to get accepted by another company. So if you can be pointed to steer away from, say, a company where you're more likely to be rejected, that could be helpful. But each company does its own underwriting, and they may have different systems, or they may have different like health conditions that they treat in a different manner. So you really have to strategize a little bit about that process as well.
Okay. And one of the questions that, because it is, right, not everything's the same, it's uniform. So one of the questions that, or one of the potential options that I was thinking of for considerations is effectively, I have a couple of points here. And we see this with our clients who some of them, they go abroad for retirement. And so if this happens, are the benefits, if one chooses to live abroad, is that a common wrinkle in these policies, or do you have to be domiciled in the US?
I don't know how common the international benefits would be, but if that's something relevant to your case, that you definitely want to make sure the insurance you're looking at does have, if you want to receive long-term care abroad, that the policy allows for that. Now, that's one
Okay.
of those situations where in many countries, care may be less expensive than in the United States. So maybe it is easier to self pay abroad. But
Yeah,
nonetheless,
good point.
you really have to read the fine print about whether the policy you're looking at might pay benefits when living abroad.
And then we've discussed the issue of liquidity and death benefit, especially with hybrids and the like. Can you just, since we're doing this sort of features thing, can you maybe unpack a little bit? Does, the issue of, does this policy, does it have liquidity? What that means when I'm saying liquidity, and is there a death benefit option for unused coverage?
Yeah. So that would be relevant to the hybrids. Traditional long term care
Exactly.
insurance generally would not have any sort of, it's just, if you decide you don't want the insurance anymore, you stop paying. It's kind of like term life insurance. Stop paying premiums, no longer eligible for the benefits. But with a hybrid long-term care insurance policy, the cash value can earn dividends. You can tap into the cash value. If you add the rather expensive return of premium provision, you could decide you just don't want the policy anymore and get refunded, or maybe it's a 90% return of premium. You could add features like that. They're expensive. But yeah, that would be more in the hybrid world, the ability to end the policy but still get the surrender value on the cash value, or potentially tap into the cash value or see that cash value grow over time with dividends.
So effectively, like these things, you have to consider them as a game of chicken is the wrong word, but it's a game of trade-offs. If your hesitation for buying it is because of some logistical reason, then to absolve yourself from that reason, you're going to have to pay for that because the insurance company is not going to carry the risk of that wrinkle, if you will, in
Right.
that's just how that game is played. So just understand that you could be listening to Wade thinking, oh yeah, I want a death benefit. Oh yeah, I want liquidity. That's fine, but it'll cost you, is
Right.
all.
None of these features are
Yeah,
free.
yeah.
They all have a value that the actuaries are figuring out what that value is and charging accordingly.
Yeah,
Now, they
exactly.
might make mistakes, and that's happened in the past with some of those past policies would have been great to get a hold of, although then premiums increase. But in general, you shouldn't expect to find mispricing from the actuaries with these policies.
No, no, I get you. And for me, as I'm listening to all of these things that we've had as we've concluded this arc, it sort of made me think it's not, long-term care is not something that's top of my mind, frankly, in terms of everything going on in my personal life, but in just, taking a step to really think about this and how it works, I'm, my takeaway is for my own self is, a hybrid sort of policy that includes this piece at the end seems very interesting to me. And, things that I would be looking for myself personally is that care coordinator at the start and really making my life easier in terms of the receipt management. I know myself, and that's something that I'm not going to be very good at. And that's not something I would want to burden my wife with if it gets to that point. So I would probably choose a benefit cycle that I would worry less about the monthly or daily and which one am I going to do. I'd be coming at it, Wade, myself personally, of what makes it easier from a reimbursement standpoint, because those are the daily frustrations that you start wondering, what have I done here, in terms of your life choices. And so,
Right. Yes. If
that's
you picked the reimbursement method and then you don't actually submit your receipts, you're not getting a lot of benefit out of that insurance.
yeah, exactly. So know yourself, kind of, when it comes to this, beyond just your ideal self, know the real self and what is going to be the easiest way to manage this. Because if you're going through this in life, you're probably going to want to reduce every possible stressor that you have. And so that's that key. And wait, are there any quick and dirty things here? Okay, we talked about things that raise your premiums, such as if you want this benefit, etc. What are ways to lower your premium?
Well, yeah, and so that's you kind of run a case, you get a quote on a policy, you have sticker shock at, oh, that premium is a lot more than I was hoping. So, just to summarize our discussion, just some of the ways you can, of course, you're reducing the benefits, but different ways to lower the premium. So, choose a lower level of inflation protection for the benefits, reduce the amount of the periodic benefit, that's just reduce the daily amount or monthly amount, reduce the total benefit base available, maybe a shorter benefits are available for a shorter period, 2 years instead of 3 years, that sort of thing. Add a longer elimination period. Instead of 60 days, make it 90 days or 120 days. Uh, for a couple, looking at a shared policy, like a pooled policy, could help reduce the costs relative to having two separate individual policies. If you have the option, starting the policy, I guess this one doesn't work, but start the policy when you're younger. It's kind of too late to do
Yeah,
that if
yeah,
you're looking at it now. But if you did start at a younger age, that can be a way to lower premiums. And then also including a rider in the policy where you may not have a lot of coverage initially, but you've pre-approved that you can make future insurance purchases. You can get a rider that allows you to purchase additional insurance in the future without having to go through underwriting again. Now that rider has a cost, but it would allow you to spend less on premiums today with the option to increase that coverage in the future. So those are
gotcha.
some different ways to help lower the premium.
And
Again, not a free lunch.
no, it's not a free lunch, but if I'm looking at it for I'll use my own self as an example. I would probably want to play around with the elimination period, simply because to me, long-term care is to avoid a catastrophic outcome,
Mm-hmm.
right? And if
High
again,
deductible.
this could also change, who knows, right? There could be exceptions to this example, but I'm willing to bite it off at the beginning, simply because I'm assuming the initial bite from the apple, me paying out of pocket, let's say for 3 months, 6 months, isn't going to crush me. It'll be having to pay something for 6 years that will crush me. And so I would err on myself personally on if I'm looking at all of these, the elimination period from my vantage point. What do you think, Wei?
Yeah, and that is a way to kind of get yourself back into the scenario where insurance works better with low probability events. So the higher the deductible or the longer the waiting period, you are pushing it off towards this is if I have 10 years of expenses, that's incredibly expensive. The probability of that is low. And so the more I can focus on just getting that tail
Yeah,
benefits by increasing
that's
the
exactly it.
deductible.
I'd be looking at it to see how can I cut off the right side of the tail.
Right. And increasing your deductible or
Yeah.
increasing your waiting period is a
The
great
the
way
other
to
the other
do that.
thing that I'm doing is athletic greens. I'd be consuming athletic greens. No, that's that thing that they pitch in the Huberman podcast. That's one of these
Oh,
health supplements.
oh yeah, too.
No, I'm kidding. But yeah, the joke is, stay healthy as long as possible. The reality is, as you get older, health is that much more important. So, keep track of that. That's the good old-fashioned way of trying to reduce your costs for long-term care planning. But as we conclude this, what are some basic takeaways? What's the action plan? If someone's listening to it, what are the cliff notes here?
Yeah, so let's just, yeah, a good way to summarize what are the steps towards building a long-term care plan. First, you kind of want to do a tour of the community. What options are available? How much would it cost uh, to for the different? If you find an assisted living facility that you think is really nice, so nursing homes. Are you considering a CCRC? be a good time to just collect information on CCRC options, decide where you might like to receive care, figure out how much that may cost, and then that can give you a target. Okay, how would I cover that cost? Think a little bit too about how other aspects of your budget might be offset if you do need to move into a long-term care facility or receive care at home. What are the in-home care options in the community? That sort of thing. Just really take assessment of the available options, how much they cost. It's just a way to start thinking about what might this long-term care picture look like. Then next you can think about, well, what is my default if I don't do anything? I have a default long-term care plan. What is that going to be? Do I already have long-term care insurance? The case with me, where do I have a life insurance policy that might allow for that accelerated death benefit rider to pay for long-term care insurance, or do I have other policies? What family members might be able and willing to help out with a long-term care need? What kind of reserves might I already have earmarked or set aside to cover long-term care? For some people, it's just they'll treat the home as a reserve asset that could potentially cover their long-term care needs.
Well,
Uh,
this is a good
mhm.
point in terms of bleeding into the next point, which is self-funding estimates. Okay, once you've done okay, you looked at the options, the costs in your communities, you understand what the default plan of care will be. Taken contingencies into account with family members who may be willing to help out, et cetera. At least you've thought about it. You should talk to them, et cetera. But if you're doing a plan, what are realistic numbers as well? So you're in the ballpark of, we talked about earlier, what are the cost of funding estimates, if you will.
Mm-hmm. Yeah. Just in trying to assess how much would it cost. Can I afford that? Self-funded. If Medicaid's an option here, like just how much countable assets do I have before I would be eligible for Medicaid? Uh, if I'm including other family members in the planning, are they willing and able to be long-term care providers? That sort of thing. How much if and then just even if I'm self-funding or not self-funding, still how much reserves will I need for out-of-pocket expenses that's not covered by long-term care benefits or that's not covered by Medicaid. If I don't think I'll need Medicaid, how much am I setting aside reserves?
Yeah,
Is
because
that realistic? Uh-huh.
even if you're not going to fund 100%, you want to know how much you could potentially fund simply because the elimination period decision.
Oh yeah. Well, that's part of right. If you have a lengthy elimination period, make sure you have reserves set aside that can cover that lengthy elimination period. So your long-term care contingency, it's your the way we talked about like what is the cost of long-term care. If you have insurance, it's the cost of premiums. Well, it's the cost of paying for long-term care minus the benefits from any insurance policies plus the premiums. And so if you're self-funding, you take the insurance piece out, it's all out of pocket. If you have insurance, there's still going to be an out-of-pocket component, but the overall cost will be less out of pocket since you've got the benefits covering
Got you.
whatever
And,
portion of that.
and if so, transitioning from self-funding to insurance funding, if you're doing the insurance, remember what we've spoken about before, which is there's no real benefit to waiting in terms of, oh, I don't want to pay the premiums. As Wade pointed out, the inflation, adjustments and the increases and the like don't really make it a slam dunk for you to wait. If anything, there could be an argument to be made for getting it as soon as practical, not as soon as possible, but as soon as financial planning centric practical it is. Another point that may not be a dollars and cents thing, but maybe just a ticket to the dance is you want to make sure your health allows you to qualify for coverage. Let's say you're healthy now, right? If these things, if you don't get in, it's too late. Then, if for whatever reason you don't qualify, then it's all a moot topic. And so you want to make sure that you do it when you're young enough that you can qualify. Obviously, who knows the unknowns, but people get a sense of things over time with their own selves. Wade?
Yeah. So if you are thinking about insurance, right, will your health allow you to qualify? how much of that long-term care spending risk do you want to offset with insurance? Can you afford that? Or like, how much can you afford to offset through insurance? Then how would you pay for the insurance? Is it going to be through like given investment assets, or maybe you have other insurance policies that you can exchange, and that could be a way to get a hybrid policy. You may have life insurance that doesn't have long-term care benefits. Well, you could do an exchange to get, I think 1035 exchange, I think is the term, to get that into a new policy that has life insurance with long-term care benefits as well. And once that's in place, how would that impact the amount of reserves you feel you need to have set aside to self-fund or to pay the portion out of pocket that's not covered by the long-term care? And can you comfortably do that?
Okay, and so just because we've spoken about it a couple times, and this is our last episode on the art, can you give a quick, this traditional long-term care may appeal to this type of person, hybrid policies may appeal to this type of person.
Yeah, so with traditional policies, you might want to look at those. And a couple of points we didn't really get into detail in the episodes because like taxes can get a lot more
Too late now.
complicated.
Too
But
late now. Wait.
you're generally not going to get the tax deduction for premiums with hybrid policies, but that might, again, consult your CPA, but you might be able to get tax deductions on premiums with some of the traditional policies if that's a consideration. There are state partnership plans that could help protect assets for Medicaid planning with traditional insurance that you wouldn't find in the hybrid world. And just if different inflation riders might be, they might have more flexibility with the traditional long-term care insurance. Now, with the hybrid insurance, that's where what we talked about was the reason people are moving in that direction: stability for premiums. They can't be increased on you. Having that backup so that you don't pay all these premiums and don't get anything if you don't have a long-term care need. There will be a death benefit. If you do have health issues that make it harder to qualify for traditional insurance, but they're not so bad that you are still able to qualify for a hybrid policy. And also you may have, like I was just saying too, an existing life insurance policy that might be easier to exchange into a hybrid policy. Could all be reasons to consider a hybrid approach.
Okay. And so then to wrap it off, that's selecting the plan. Any takeaways from implementation and monitoring? What are some quick wins to give to our
Yeah.
listeners?
Well, and we didn't talk much about this, but it's important. Once you have your long-term care plan, share it with the relevant people. If your long-term care plan involves your adult children, finding your policy, applying for your benefits, keeping track of your receipts, submitting them for reimbursement, make sure they know about this because they have to be willing and able to do it. But even beyond that, they have to know the policy is there, that they won't be able to use it if they don't know it's there. So make sure you've shared with the relevant individuals in your life what your long-term care plan is. Also, if you have long-term care insurance that has that care coordinator, make sure your adult children or whoever we're talking about here knows about that, because that could be a very stressful time. And if they didn't even know they could have talked to a care coordinator, well, the care coordinator might be able to help out a lot, but those relevant family members need to know about this because, again, when someone needs long-term care, they may or may not be at a stage where they're able to share this information effectively at that point. You want to share it when you still are full of sound mind and able to make sure you have these conversations with family members. Then once you have the long-term care plan, of course, reviewing it over time, annual updates, making sure everything looks right, seeing if you need to make any sort of tweaks, maybe some new community opened that you want to check out, that sort of thing. And Alex already made this point, but of course, just being active, taking care of your health, working towards as best as you can, avoiding having to need long-term care is important as well.
There it is. Wait, what's your zip code? Because I'm gonna maybe move over there and we're gonna play pickleball every day and things like that. Where are you at, man? No,
I'm in Texas where the cost of care was less. So.
yeah, I got you. No, listen, it's been a good arc. We kid about, oh, it's been a long one, but again, it has to be, and it's an important topic. You'd be, well, I would say you'd be surprised, but maybe not because you guys write the questions in for us. But we've gotten a significant number of requests for this arc, I would say. Wouldn't you think, Wade, over the last year? About, hey, when are you going to talk
Yeah,
about
it
long-term
does
care?
seem
When are you going
like.
to talk about long-term care? Yeah,
Mhm.
that kind of thing. And so there it is. We told you we'd get to it, and we got to it. Any parting thoughts with regards to this arc right now, Wade, or are we good?
Well, I think we're good. We've got the basis now to make sure you have long-term care planning as part of your retirement plan. It's very important. So please, it's not pleasant to think about, but it's very important. So please make sure you make these decisions and share them with your family members well in advance of the need.
And that's one to grow on, everybody. Thanks for listening to this week's episode of Retire with Style. Alex signing off.
Yeah, we'll catch you next week on Retire with Style with a different topic.
Bye.